The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Good morning. Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings investments in your retirement here on our show. Our show is all about saving money and building up wealth in the world today. Our motto and our philosophy is to save aggressively and invest conservatively. That's save aggressively and invest conservatively. That's the key to building up wealth. You put away as much money as you can in your tax-free programs. You get a tax deduction. They grow tax-free, and then you take the money out when you retire and you build up wealth. You use the power of compounding of money tax-free. And so we always want to start the show talking about that to encourage you to save money, to build up wealth, and to understand the world. That's the key to building up wealth over the long term. We got a lot to talk about on the show today. We always try to bring you the trends happening in the world. We try to give you a different spin on what we're seeing that you're not hearing elsewhere, so you can really understand things. Oftentimes today, the mainstream media just picks up a narrative and runs with it, and it's clearly wrong. And we try to point these things out to you. We try to help you understand, what it takes to retire successfully, how to get there. And it always starts out by going to your 401k, your savings programs, putting away a minimum of 10% plus a company match to get you up where you need to be over time. It's called income-based savings, and it simply means if you're making $30,000, $300,000, you're going to be putting away enough income for your retirement, and so in addition, you get your tax deduction from the government as well, and plus you get tax-free growth for the next 20, 25 years that you work. So first take charge of your retirement. Look at where you are. See how much you're saving. If you're not there, now's the time to boost up that savings and move forward, and then conservatively manage the money. Remember, save aggressively, conservatively manage the money. It typically, if you look at the power of the compounding of interest, it is just gigantic. It's more slow and steady. The same thing over time with rather than jumping around all over the place. You steadily build up wealth over the time, and you try to minimize your mistakes and maximize your returns. That's the key to building up wealth and understand the world today. So, that's the first step. And then, so where we are today, we've got the first. We just got out of the second quarter, and it was really pretty remarkable. If you look at the market, it sold off in April, which is actually the first day of the quarter. And a massive sell-off. Well, not the first day, but it was around that. Huge sell-off going into a bear market, and within about 1 point of a bear market, the market was down 19%, and then it has one of the biggest rallies in history off of a 15% decline. And so what that did is it was just extraordinary. I mean, in many ways, it was really fascinating with the as far as if you look at it, the quarter began. President Trump declared, it was Independence Day or something from trade around the world, and we're gonna put tariffs on. He puts the tariffs on. Wall Street in 3 days freaks out. The market drops. Some stocks were down 15, 20% in 3 days. And then the market starts going up. It has one of the biggest recoveries in history. But what happened is that if you look at it, the quarter two, it was up about 9%. 9 or 10% for the quarter, so it went straight up. So it came out, it collapsed, and then it went straight back up again afterwards. And incredible volatility with the Trump tariffs. But then the war broke out with Iran and Israel, and we were dragged into it, and no one knew what was going to happen there, and the market basically froze. So Trump puts on some tariffs, market freaks out, falls down 15%. Almost immediately, the war breaks out in the Middle East. The U.S. is engaged in bombing, and the market basically freezes up and barely moves 1.5%. And so, just an incredibly volatile second quarter. We're still dealing with a lot of these issues, and so the question is, where do we go from here? And I think this is something that we want to kind of continue to watch. It's like I said, it's a very unusual market. Ridiculous amounts of volatility. I mean, the second quarter was one of the most volatile quarters we've had in years, just for being up and down. And the remarkable thing is, we had a war breakout, and the volatility suddenly vanished. And I don't know what to make of that, but kind of it is what it is. And then so here we are. So markets are up about 9 or 10%. They're up about 5-6% in there. If you look at gold, silver, they're up over 25%. Precious metals continues to go up, and so underneath all the volatility in the stock market, gold and silver keep going up, and this is clearly telegraphing something here. And I think we have to pay attention to it. I think the world is shifting away from the dollar to some extent. I think, we've done a lot of work on this in the precious metal sector. We own, quite a bit for our clients in this area, and we've followed this area for decades and decades. And because one of the interesting things about the precious metal sector is typically, when you get this type of performance with gold and silver up 25%, the markets are off 10 or 15%, and it just gives you gigantic amounts of alpha against the market when those times come. And the strange thing is, the markets are kind of up a little bit, which is very unusual. And so I think most of the returns appear to be in the big cap, the tech stocks, and the Magnificent Seven, which appear to be dominating the market. So the market's broken out to new highs. So here we are. We're in the year's gone so far. Enormous volatility, wars breaking out, tariffs, interest rates going up. The dollar's had one of the worst performances. First half of the year, actually, in decades. And so really, what's going on? And then you could say, well, Donald Trump's back in power. We don't believe that. I don't think the dollar plunges 10% and gold moving up 25% like it is. And it wasn't off a bottom. It wasn't like it was in a trough or anything. Clearly something else is going on, and we have to recognize this. And I think when the U.S. and we got involved in the Ukraine war, it was cooked up by a bunch of people, this wherever, and so here we are. Russia invades. The U.S. put sanctions on. They froze the Russians' assets at the Federal Reserve, and at that point in time, most countries in the world decided that, hey, we need to start spreading our risk. We can't depend on the U.S. because if we get involved with a war, they get mad at us. They could confiscate our treasuries or kick us out of the SWIFT system, which is the banking system. And so we have to have alternatives. I mean, at the time, on the Max Out Savings Show, that week we said this was an incredibly foolish move. It was going to have long-term consequences. And so here we are. And this is, they were so hell bent on sticking it to the Russians that it was a real good short-term gain with massive long-term downside. And they just, well, hey, we're here and now. We want to get our project done, so we just don't care what happens in the U.S. long-term. So here we are today. Dollar's going down, gold's going up. Brazil just said that they would like to get a de-dollarize in the world. Lula just said that this week, and we're dealing with the aftermath of just reckless policies under the Biden administration, where you had basically, for all practical purposes, a senile president and a group of radicals underneath him pushing their policies through at the expense of the United States of America long term. So where do we go from here? And I think what you have to do is you've got to really sit down and figure out, what are the big trends? What is happening? What's really shaping the world today? And I think some of the big trends are clearly there is a movement across the world to spread out risk, and I think many people in the world don't view the U.S. as a stable ally, as they tend to as a fair weather friend, which is quite frankly contrary to what we've done over the last 100 years, but we've allowed a small group of people up there to sit there and get a hold of our foreign policy and engage in these wars, and then engage particularly in sanctions. Anytime we didn't like anybody, they put sanctions on them, so we become untrustworthy. I've said it once, I've said it I don't know how many times here on the show, is that, look, if I ever become a dictator, the first thing I'm going to do is I'm going to go get the United States to throw a bunch of sanctions on me, because then I'll never leave power at all. Because the sanctions have the worst record. We've been sanctioning Cuba, Fidel Castro, the guy lived forever. Once we put the sanctions on, he was guaranteed the power. And it was and so we have to understand what works and what doesn't work. And I think President Trump is making big moves to go into things that work. And I think you have to look at some of this stuff. And we're going to talk about some of this stuff on the show today. Where do we go from here? We just passed the big, beautiful bill. And there's a lot of things in the bill to sit there and try to get the economy going. And one of the more fascinating things is some of the things that didn't get in the bill. There was a part of the bill that was going to sell off federal lands, small portions of federal lands. And it's real interesting. I've been talking to a number of people on that. All across the West, in Texas we don't see that as much, but much of the West is federal land. And people use the federal land. They go camping. They go, bird watching. They go hunting. They go fishing. They're out there all the time. And there was massive pushback. The headlines of the papers. I saw headlines of the paper the other day. The government land sale pulled from Big Beautiful Bill. Someone was telling me that they called up their senator. I think they said they dialed almost 100 times to get through. There were so many people calling on the bill. I had people telling me, "Look, I've been a Republican all my life. I'm switching to Democrat if we start selling off federal lands." And what I heard was, we don't want Bill Gates and BlackRock and billionaires buying up all the land in the United States at the expense of people, which is really fascinating. And the biggest pushback was really Republicans on this issue. And so there's a lot of stuff that passed in that bill, but one of the more fascinating things was that was really some of the pushback on some of the ideas that, hey, this is a good idea, but actually, the American people are in no mood to sell off land, to sit there and to billionaires to sit there and fund these deficits and other programs, which is really interesting. Anyway, we're going to talk about some of the ramifications of the bill after this quick break right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
Hey everybody, Charlie Kirk here. Ted Gioka, the founder of Max Out Savings Advisors, always says, save aggressively and invest conservatively. He specializes in helping people grow their retirement account with as little risks as possible. Ted combines working knowledge with the intuition gained from over 25 years of experience of value investing in the stock and bond markets for retirement accounts. Like you, Ted is deeply conservative in life and in his investment approach. His risk strategy allows him to anticipate market downswings to protect your money. Ted is also the conservative host of the Max Out Savings Show. You can listen to him every Saturday morning at 10 a.m. right here on The Answer. If the idea of saving aggressively and investing conservatively appeals to you, the best way to get to know Ted is to call him. The number is 713-627-0400 or visit maxoutsavings.com. That is maxoutsavings.com. Call Ted right now, 713-627-0400 or visit maxoutsavings.com.
In the 1970s, the big song was the Bee Gees' Stayed Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement. Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday at 7 a.m. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com. This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com.
Once again, here's your host for the Max Out Savings Show, Ted Gioka.
Welcome back to the Max Out Savings Show. We're talking about savings, investments, your retirement. The big beautiful bill passed this week, and there's a number of programs in it, and all types of things. There's cutbacks in some services. There's cutbacks in Medicare. That they've extended the Trump tax cuts from the first term that were in there, which would have been huge tax increases if they hadn't across the board. So there really weren't tax cuts. There's no tax on overtime to a certain amount. There's no tax on tips. There's also some special thing for seniors in there for Social Security. So there's a number of different of programs in there to help people out. And so what we got to do is sit back and look and say, look, how is this going to change? And I think in order to understand your retirement and returns this year, I think you have to understand what is Trump trying to do. And I think what we want to do is we want to look at that and we want to sit there and see what he's doing. And what he's doing is he's come up with a program to sit there and get us out of these budget deficits. Right now, over the last 5 years, we've been running $2 trillion. Budget deficits about 6% plus of GDP. One year it dipped a little bit. A couple years it was way above that, 6.5. In the 2020 it was very high, and so the deficits are out of control. And we've got trillions of dollars worth of debt. Recently, as 6 months ago, we were borrowing $1 trillion every 100 days, and so what we're looking at is a situation where federal spending is out of control. And so how do we sit there and deal with this? And I think this is going to be the really tough thing about the whole thing. Right now we've got $37 trillion worth of debt out there, and so how do we handle the situation? So he has a plan. The plan is multi-pronged. A couple things. The strategy is he would like to grow. He wants to grow the economy out of the debt, and so hence the tax cuts. So if the economy grows, the tax revenue will go up. The debt will go down. It's very hard to sit there and have a stagnant or declining economy and have $37 trillion worth of debt. Our economy is only $25 trillion a year, and so how do you pay this off? And so if it goes badly, we're going to be looking at a hyperinflation or collapse of the U.S. dollar, which is going to wipe out your savings. It's going to wipe out your income and your net worth. And so this is we've been hearing about this for decades, but going back is decades that this was going to happen, but it always seems to be put off and put off and put off. We're going to run out of money for Social Security. We're going to run out of money for Medicare. We're never going to run out of money because we'll just print money, but the value of the money will keep falling. And so what makes this a little bit different is this 6% plus percent deficit spending of GDP every year by the federal government. And the other thing is, if you look at the price of gold and silver, look, clearly somebody thinks something is going on. And so whoever those somebodies are, they got a lot of money. They got a whole lot of money. And so something is going on. Our interest rates are going up. If you look back to 2019, gold was at $1,200 an ounce. It's at $3,400 an ounce. And clearly, again, something's going on. If you look at the dollar is down 10% this year. So he has to do something. And the dollar, by the way, is about the same place it was in 19, which is kind of interesting, but it's clearly it was as high as about 114, 115 a couple of years back, and now it's down to 90, 96, 97. And so this trend doesn't appear to be slowing down yet there. So Trump's got a problem. What is he going to do? So his strategy is, look, we're going to grow the economy. I need more taxable income. What do I do? So one thing he does is he puts tariffs on the products coming into the United States. He looks around and goes, look, we've lost all our manufacturing to China. And when they've closed down the manufacturing in China, in the United States, it's gone to China. Well, if you look at China's GDP growth over the last 25 years or so, it's been up until just recently, it's been 5%, 6% every year. Virtually very little economic slowdowns at all. I mean, many times it was more than that. It's above 30 years. So as we were closing down all the factories were moving to China, and China's GDP kept expanding with virtually no slowdown. Well, think about this. What if you were to move the factories back to the United States? What would that do to the U.S. growth? Well, if you look at China, the answer might be, well, hey, this would help U.S. growth. Yeah, because it's very hard to get people to spend more money if I have $1,000 a month in income, to spend, so to speak. Well, it's hard to get me to spend more than that $1,000. I have to take on debt, or I have to do something, or cut back something. But and so I buy products, and part of that money goes overseas. What if I move some of the factories back, and then my money spent goes into the United States economy, which counts to more GDP? Then, because remember, they subtract off the money that was spent on the imports from overseas. So if I can cut back the imports, if I can bring the factories back to the United States, I can get the growth, and then I can start paying back the deficit. So but in addition, he puts tariffs on. Plus, I get more income to further reduce the deficit. So his strategy is to jawbone companies to get their factories back to the United States, use the threat of tariffs and other things to get them back, and then put tariffs in place to sit there and boost the tax revenue, which we need to pay off the deficit. So that's the second part. First part is grow the economy. The second part is use the deficit, the tariffs, to grow the economy and also increase tax revenue. And then the other part that he wants to do is remember, we have $37 trillion worth of debt. Joe Biden, when he came in, last year or so going into the election, he moved a huge amount of borrowing short term because he didn't want to push up long-term rates and affect him on the election. So he had the Fed pushing down rates for him. People forget, right before the election, a month or so before the election, the Fed cut rates 50 basis points to help him out. They're completely apolitical, right? But so Trump, so again, we're paying about $1 trillion a year on debt, on interest on the debt. Well, if a good chunk of it's short term, if the Fed were to cut rates maybe 150 basis points over 6 or 9 months, let's say it's 30% of the debt is short term, just for numbers, and let's just say there's $40 trillion worth of debt. That's about $12 trillion. Maybe it's $10 trillion short term because it's really 37. So about $10 trillion. That's 150 billion. You cut interest rates 150 basis points. That's 150 billion dollars worth of savings that can come in. So if he gets $200 billion from tariffs, he gets $150 billion from that works out to be $350 billion. And if he can cut $200 or $300 billion or more off of, let's say he cuts $200 billion in savings there, that's $550 billion. And let's say he grows the economy on top of it, you can see how we can start reducing these deficits. That is the plan. That's why President Trump keeps pushing pushing the Fed to cut rates. He's like, look, why aren't you guys cutting rates? And Powell's like, well, we're not really seeing we don't know what's going to happen with the tariffs. And the Federal Reserve, how many years ago we had a show, we had Bob Rubin on a long time ago, and he was Treasury Secretary at the time, or just retired as Treasury Secretary, and he made the comment, look, the Federal Reserve can't control, they control short-term rates, they can't control long-term rates. They can for a little while, but not. So this is a plan he has in place. Now, some people say, well, that's like, you can't have them cutting rates because that's going to, cause inflation to take off. Well, this is the same people that, using the modern monetary theory that the U.S. could take on as much debt as they want, came out of Harvard University. This is what we paid $400 million a year for. At Harvard, was that if you control the world's currencies, then you can borrow as much money as you want, and so it didn't make any difference. Which just complete ridiculousness. So the strategy is they push down the short-term rates. Again, you can keep the short-term rates down. So this is the strategy that Trump has in place. His Secretary Bessent he's got him handling that. This guy understands currency markets. He understands asset markets as good as anybody in the world. He was involved in some of the when they tried to break the Hong Kong peg. He was involved when George Soros was. He was one of the architects when George Soros broke the pound. I want to say 25 years ago or so on that. And so he understands. And so they're pulling the levers that are going to make things happen to change, to improve the fundamental position of the financial position of the United States of America. And by the way, it's disappointing because Then there's a Wall Street Journal. Someone in there was calling Trump's calls to lower rates self-serving. It's like if Trump does something to help himself out and the United States gets better, it's kind of like bad because, well, we're not really all in it in the United States. We're just our main even the Wall Street Journal, they're so concerned about what Trump is if he's going to look good. So if the program works and things do well and the economy booms, it's going to make Trump look good. So Trump really just did it to make himself look better. I mean, how shallow are these critics of Donald Trump? I mean, it's really just remarkable. It's almost like they're all hoping the whole world U.S. economy collapses so they can say, and everyone's thrown out of work, everyone's wiped out, there's bread lines, but they can go, see, I knew Trump was wrong. I mean, it's just I mean, I really think that Trump TDS, the Trump derangement syndrome, is a genuine thing. I mean, I think it's a legitimate thing where people just lose complete. They're so concerned about Trump that they're willing to sacrifice anything to get him, and it's sad. But this is a reasonably good concrete proposal, and so this is the strategy, and it's important to understand the strategy here. So the question comes in is where do things go from here? And a couple thoughts. We've got the bill passed, the big beautiful bill passed. We've got a lot of different things in there. We got some tax cuts, but they did a lot to try to target the middle class with the TIPS program, the overtime, the some of the stuff for seniors for Social Security. Those are positives. I think a couple things. I think wealthier retirees need to understand and continue to look at that. Look, we have $37 trillion worth of debt. We're fighting like the Dickens to try to reduce that debt and not let it get out of control. We have $2 trillion deficits in the last 5 years. Eventually, they're going to have to get money from different people. I think over time the taxes on the wealthier are going up. But I think for wealthier retirees, I think they're not going to get the tax benefits, be it your Social Security is tax-free up to a certain point. Be it, with the electrical vehicle, the tax goes away after a certain the tax credit goes away after a certain point. I think you're going to see more and more of that stuff where people that can afford to get they're going to get some of their benefits reduced or taxed. And so I think it's going to be more and more important than ever to manage your retirement income. And we see a lot of this with people, with the big oil companies. They'll come into us and have $2 million in their qualified plans and really have maybe 35,000 or 40,000, 50,000 elsewhere. And I think it's important to build up either non-qualified savings, which is like bank accounts, CDs, money market, just in your name, not for the benefit of or IRA of or 401k, and do those type of things, and also the Roth, because I think Roth is going to increasingly be a good place to be, and you should be saving some money in a Roth if you're in a company, because when you need to buy a car, when you have a healthcare expenses, you don't want to kick up your retirement, your income, and then which will knock you off of some of the subsidies you're getting at retirement. And so I think this is going to be a bigger and bigger deal going forward, because we really have to understand the $37 trillion number. Look, nobody can even count to $1 trillion. You start counting, it's like 28,000 years or something like that. It's some ridiculous number, and no one even understands how big these numbers are. So there's going to be additional pressure on wealthy retirees, and so you want to understand that, and they might not raise your taxes. What they're going to do is they're going to cut your. They won't cut your Social Security or Medicaid. What they will do is they will tax it. They will put surcharges on it, all types of things like that, and because they can't afford to cut people that's all they have is their Social Security and they're barely making it, or they don't have any health care. So that's the only place they're going to go. So I think it's important to understand that and continue as a retiree to manage your income so you stay below certain limits, and also position your retirement savings so that you have that ability to manage your income during that using Roths or savings accounts outside of a qualified plan. Tell you what, let's take a quick break. We'll be right back right here on the Max Out Savings Show.
If you've got savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
Hey everybody, Charlie Kirk here. Ted Gioka, the founder of Max Out Savings Advisors, always says, save aggressively and invest conservatively. He specializes in helping people grow their retirement account with as little risks as possible. Ted combines working knowledge with the intuition gained from over 25 years of experience of value investing in the stock and bond markets for retirement accounts. Like you, Ted is deeply conservative in life and in his investment approach. His risk strategy allows him to anticipate market downswings to protect your money. Ted is also the conservative host of the Max Out Savings Show. You can listen to him every Saturday morning at 10 a.m. right here on The Answer. If the idea of saving aggressively and investing conservatively appeals to you, the best way to get to know Ted is to call him. The number is 713-627-0400 or visit maxoutsavings.com. That is maxoutsavings.com. Call Ted right now, 713-627-0400 or visit maxoutsavings.com.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday at 7 a.m. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
In the 1970s, the big song was the Bee Gees' Stayed Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
And now, more of the Max Out Savings Show with Ted Gioka.
All right, Ted, we're going back up.
Welcome back to the Max Out Savings Show. So we're talking about, we're just talking about, look, the country's in tough financial situation. Joe Biden has run up the deficit about 23%, 24% since he was in office in 4 years. Huge amounts of debt. The debt increased $12 trillion, and so So here we are today in a situation where $37 trillion. President Trump has come up with a plan to reduce it. It's going to be economic growth through tax cuts. It's going to be tariffs to force factories back to the United States to improve growth and also to create income as well for it. Reduction of government spending through the DOGE Commission and other things. And then the final one is that they're going to sit there and push the Federal Reserve to reduce short-term rates, to cut our interest expense, all creating a situation where we have long-term growth. At the same time, we have reduction of the deficit. So that's the plan. Tell you what, let's take a call from Larry. Hello, Larry.
Yes, how are you?
Good. Yourself?
So first of all, happy 4th of July weekend. And
yes.
I had a question about the recent job reports that came out. Apparently it was a lot better than expected. And I was just wondering, where are these jobs, what parts of the economy are they from? Is it like back when Biden was president and it was mostly government employees? Or what's going on now?
Yeah, I didn't look at the latest ones, but it has been more service area, and it's not been from the government. It's been more genuine growth. I think those numbers might be a little better because I think there's more hiring. I think a lot of the illegal aliens are kind of backing away from the workforce to some extent, and I think that's helping. I mean, the hiring has been reasonably good. Almost most companies need good qualified workers, and so that's one of the big surprise is that we haven't seen a huge drop off in unemployment because again, if you're moving, my number is $500 billion worth of factories, and Trump uses $2 trillion or something like that. I think that's a lot of construction. That's a lot of factory jobs. That's a lot of all types of stuff that they're going to need people for.
Okay. Now, I'm also hearing that housing is slowing down. Is that true? Housing starts?
Yes. Housing is slowing. Interest rates have gone up, and that's hurt the housing market. And I'll tell you, actually, this is a great question. Kind of a series of them. I think real estate is slowing because I think a lot of illegal aliens are afraid to buy a house. And look, there's 10 or 15 million illegal aliens that poured in under Biden that likely they're not going to. But there's a lot of illegal aliens who live here for 5, 10, 15, 20 years. And they like to buy a house, and now they're not real sure. And I think that's slowing the housing market much more than people realize. I think it's also affecting the economy. It's leading to a slowdown in the economy. Modelo sales were down, I think, over 6% here recently. I think that some of these people are like, look, I'm not going out to a bar because I might get arrested and deported. And
okay.
And so I think this is a big story that's not really well understood out there. I think they're kind of, afraid to go to restaurants. I was talking to someone yesterday on that. Actually, I think he's a lobbyist. He's more on the Democratic side and stuff. But, I do think they need to come up with some type of program that if you've been here X number of years, we're not going to deport you right away type. I mean, I really think that the people I think they should really go after are these people that just poured into the country all over the place, are on welfare and everything else and under Biden. I mean, I think that was, we've never seen a surge of immigrants like that, and I think they're going to have to do something because I believe, and this is a bigger story. I think I really want to talk about today is I think this is a big deal. I think people are afraid to go out to eat. I think they're afraid. Someone's been here 10, 15 years, 20 years, they're thinking of maybe buying a house or something. They're just going to hold off because I'm not sure what's going to happen. If I buy this house, put all my money and I get deported, then what happens to me? So this is the housing, to answer your question, the housing market is definitely slowing down. I think the immigrant issue is a bigger thing than people realize. And I think it's also slowing down the restaurant area and other different parts of the economy, and it's also it's going to increase. It's some of those employment numbers. The number of immigrants' jobs actually dropped quite a bit, and the number of American citizens' jobs went up in the last report. It's pretty remarkable. So what's been happening for the last 4 years is Americans. Citizens have been losing jobs, and immigrants have been getting these jobs, and you can see it in the non-citizen jobs numbers that the Department of Labor puts out. Because that's a long-winded answer to your question, but.
Well, actually, that's very good. That's what I'm looking for. So basically, to sum it up, it looks like what's going on is a more honest view of where our economy is once you take out the illegals who are taking jobs, buying real estate, et cetera.
Yeah. And by the way, I believe we really have to look at the illegals as two groups. I think the more recent ones, and anyone, criminals or anything, they need to be gone. I think they're going to have to come up with the others where they either get some type of work permit or something, that type of thing. And I think they're going to come up. I mean, Trump's a pretty pragmatic guy in the end, and I think they're going to come up with something on this. I do think, and I do really think the untold story out there is this is starting to slow the economy down with because these immigrants are afraid to go out.
Well, during my working career, I've worked with especially people from South Asia who have come to this country, and they've been trying to get green cards the right way, doing everything the legal way, and all of the expense and the hoops they have to jump through. Obviously, if you're here illegal, you need to go to the back of the line because those people who are doing it right, they deserve to be heard first.
Yeah. No, they're going to have to do something on that. I think we're going to see some things happen. But good questions. Thanks, Larry.
Okay, thanks a lot.
Yeah, if you have a question or comment, you give us a call at 713-339-10. Now, so the big, beautiful bill passed. There's a lot of stuff in the bill. There's a lot of changes. They did try to adjust the bill. Keep in mind, this was a budget bill basically for the what's happened is this is a reconciliation bill because for the last, I don't know how many years, Congress can't even manage to go and write a budget. So what they do is they kind of reconcile the year before and they can pass that without needing, with a simple majority. But one of the things the big thing I think that's in the bill that again, it's not being talked about is that budget, the budget deficit, the debt limit extension. And it goes up, I think, to $45 trillion. I forgot what it was. This is a key thing. Remember, the U.S. debt hasn't materially grown we haven't been adding additional debt since about January. I think the date is the 21st. So when you see the government issued $10 billion worth of 5-year bonds, notes the other day, or whatever, that just means that they had $10 billion worth of other notes come in and they just refinanced it. So technically the debt didn't really grow. Now there's several $1 trillion worth of, so it's January, so it's February, March, April, May, June, July. So you got 6 months of borrowing that's going to have to be done. They're going to come to the markets with heavy borrowing. And the question is this going to push up the longer term rates? And I think this is something we want to watch closely. What is it going to do to the dollar? The dollar has been going down pretty much, ahead of this. And so this is the story right now. I think that what we really want to watch is how does this, the numbers, it's either $8 or $12 trillion. I've seen different ones that they've got to refinance, either borrow new money or refinance bonds over the next 9 months or so. In 9 months to a year. It's an enormous amount of money. And the question is are they Chinese? Are the Arabs? Or who Europeans? Who's going to step up to buy all this debt? And lately, the biggest buyers have been the American people. So this is something that we do want to watch closely and kind of see what's going on there. And if you look at it, the dollar's been kind of plunging down ahead of that. Pretty much the dollar, when we started doing the deficit, okay, January 20th, the dollar was about 110. It kind of had a big drop that week, so I'm not sure the exact timing of it. But right about the time they did that, it was 110. Since then, it's gone down to 96. Since we've had that debt limit in place, the dollar has plunged. Now, you could mean once the debt limit comes off, it goes up. But this is going to be one of the key things. Does this push longer-term interest rates higher? Larry just asked about real estate, which is clearly it's dropping here. It's not going to be a good thing if rates go up. So this is something we want to watch. Now, here's the interesting thing. The S&P 500 has hit a new high this week. It broke out of a high. The high was back in February, February 3rd, right around there. And since then, in this week, it broke out to a new high. It's a holiday week this week. July 4th is one of the strongest periods for the market. The question is this a breakout to new high levels? Or is this like a false breakout, which, there's a false, it's called a bull trap. The bull trap is when you do a breakout and you go, oh, wow, it broke out, of a double top or a triple top, it's going a lot higher, and they all come piling into it, and then it's a fake out, and people start dumping into it, and it goes down again. But I do think we want to watch that closely. So there's a lot of big changes still happening in the market. I continue to think you want to spread your risk out. I'm talking about this on the show, but there's a lot of potential. This year already we've had tariffs, we've had a debt limit, we had the big, beautiful bill, we had the war in Ukraine, and we had the war in Iran. This massive, plus we have a giant trade war with China right now. These are very volatile times, and the potential outcomes, I think we're really good at predicting them, are really spread out much more than normal. So you want to spread out your assets into stocks, bonds, some commodities, other types of things, short-term bonds, yielding close to 4%. These are options to spread your risk. Anyway, to protect yourself. Anyway, if you need some help, go to our website, maxoutsavings.com. You can sign up for our free newsletter. It's maxoutsavings.com. Also, you can go to the website, get the phone number. You can give us a call if you'd like to set up an appointment, to schedule an appointment with me here in Houston, Texas, at Max Out Savings Advisors. We use Schwab to hold the assets. So if you need some help, I'd like to help you out. Just go to the website, maxoutsavings.com. And remember our motto and philosophy, which is to save aggressively and invest conservatively. That, my friends, is the key to building up wealth over the long term. Save aggressively, invest conservatively. I hope everyone has a great 4th of July weekend, and God bless the United States of America.
This has been the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.